Hi, I'm Joe James, and in this video, I'm going to give you an introduction to how venture funding works for startups in Silicon Valley. Bootstrap is one term you're going to hear a lot. Bootstrap means that the company is funded solely by the founders and possibly their families, but the ownership of the company is retained internally, and there are basically no outside investors. So it's very challenging to do, obviously, with no funding, to get a product out to market and make a profit. So typically companies don't go the bootstrap route because they need that funding to help hire employees and to get the product out to market. So by bootstrapping, you retain all the ownership of the company and therefore all the control of the company, but it's also much more challenging to succeed. Incubators and accelerators are organizations that help small startups get the resources they need to get started. So commonly, startup companies are founded by technical people, but they need legal services, they need marketing support to help figure out how to promote a product, they need management mentorship, co-working space helps give them a place to work until they get a product to market, and they need access to angel investors so that they can pitch their product or their technology to investors to get funding into the company. Accelerators and incubators do all these things. Now, incubators typically focus on very early stage startups, and accelerators may focus on any stage of startup. So some of the most successful and well-known accelerators in Silicon Valley are Plug and Play, Y Combinator, and 500 Startups. And just to name a few of their successes, Airbnb and Dropbox both pass through Y Combinator. So seed funding is the earliest round of funding, and in this round typically you're looking to define the product, the market, and the customer base, and get a working product out to market. It's going to be like a first generation product. It's not going to be perfect. You're not going to have a big presence in the market, but you have to get a working product out to market. So seed funding is typically provided by what's called angel investors, which are early stage investors, and they may invest anywhere from $500K to $2 million in the company. And one typical requirement for angel investors is they like to see an option pool set aside for senior and valuable employees to reward them, to give them incentive to work harder for the company. So some stock options will be set aside into an option pool typically at this stage. If companies survive past the seed stage, they may need to raise Series A funding, and they'll typically use that money anywhere from $5 to $15 million in funding to scale their user base, either geographically or into new vertical markets. How to monetize their product, if they haven't thought about that yet, they give it a lot more serious thought. Series A funding gives startups the capital they need to hire a few more employees, and more important, it gives them management guidance to help the startup succeed. That management guidance and the contacts that Series A venture capitalists can provide are very valuable to startups. If companies survive past Series A funding and they need more funding to continue to grow, they'll raise a second funding round called a Series B funding, which is typically $5 million to $50 million in venture funding. And they'll use this money to scale their user base and their revenue, and also to expand their products. And they may sometimes also make acquisitions, either of outside technology or a company for their customer base, so that they can grow faster. Series B funding may be provided either from some of the same investors that invested in Series A. They may provide follow-up funding in Series B, or some new venture capitalists may join in Series B. And just to give you a rough ballpark, it's typical for venture capitalists at this point to own about a third of the company, and the founders to own anywhere from 20 to 50% of the company. And if needed, if the company is continuing successful, they're gaining traction in the market, but they need more money to grow before they can either be self-sustaining or be acquired or IPO, they may have a Series C and even possibly a Series D funding round. And these rounds are typically $10 million plus because the startup is at this stage fairly well established. One goal or exit strategy for most startups is either to be acquired by another larger company or to IPO, to go public on the stock market. Both of these outcomes enable their shareholders or investors to cash out. In other words, they can sell some or all of their shares to other investors. It's called a liquidity event. And venture capitalists typically only want to invest in a company for a few years until that company gets some traction It's able to grow and establish its position in the market, and then cash out and use that money to invest in other small startups. So as the company grows, the founders may be giving up their control of the company and ownership of the company, so that instead of having 100%, they end up with less than 20% of their shares. So they have a lot less control, but the goal is to bring in investors that can help guide the company towards profitability and success. Also, to have more capital that they need to grow the company and make it successful. So what they get in exchange for giving up that control and that equity is a much greater chance of success. They get a smaller piece of a much bigger pie. That concludes my video on venture funding. I hope this video is helpful for you. If so, please click the thumbs up and subscribe to my channel. I'm Joe James. Thanks for watching.